IFRS 9 was actually issued all the way back in July 2014. But the project was already in existence as early as 2009, right in the middle of the global financial crisis. And IFRS 9 replaced the earlier accounting standard on financial instruments, IAS 39. And basically, the objective of IFRS 9 is to provide a simpler version of accounting that reflects more both the characteristics of the instrument as well as how companies are using those financial instruments. IFRS 9 became effective January 2018. Now, IFRS 9 applies to all reporting entities that adopt IFRS in its regulatory filing, regardless of industry. It's not just for banks. It's not just for mutual funds or investment companies. It's for all types of entities, either a merchandising business or a service-oriented business. As long as they use financial instruments, as long as they have financial instruments in their books, IFRS 9 applies to them. The focus of IFRS 9 accounting is not on the reporting entity or the issuer, but on the contract themselves, the nature of the cash flows contained in the contract, and how the company uses those contracts in their business. So there are three main sections of IFRS 9. So the first is classification and measurement. We'll be talking about how the financial instruments in the company's balance sheet are categorized, and those categories drive the measurement basis of those financial instruments. It also tells us how value changes are accounted for. Are they presented in the income statement, or are they presented as part of other comprehensive income in equity? The next section of IFRS 9 is on expected credit loss, which is an impairment provisioning section that tells us under the prudence accounting concept that based on experience, not all credit assets will be recovered timely or at all. So ito yung pang provisioning mo, provision for or allowance for probable losses or bad debts. It has been changed compared to the old accounting standard. The third section of IFRS 9 is on hedge accounting. Basically, it's a specific topic that's an exception to the classification and measurement rule in dealing with risk assets and hedging instruments such as derivatives. And we will discuss those items in greater detail in the next session on Thursday. Okay. So as mentioned, we've highlighted 4 different types of financial instrument. Debt instruments, remember the definition of fixed or determinable amount, a promise to pay, principal and interest. Equity instruments, these are residual claims in net assets. There is actually no promise of returning any principal or interest. Rather, the holder is given certain corporate rights to elect a board of director or to make major corporate decisions or receive dividends. That equity holder, investment holder, can also transfer those rights in exchange for compensation. So someone can sell shares of stock at a higher price than what they purchased for it, thus generating capital gains. Derivatives are contracts that the payoff and value fluctuates depending on where the underlying market factors end up. They require little or no net initial investment, and they are settled at a future date. Insurance contracts are contracts wherein the issuer will compensate the policyholder should an insurable event result in a loss to that policyholder. And for purposes of IFRS 9, insurance contracts are excluded kasi may sarili po siyang accounting standard, IFRS 17, which we will also discuss on Thursday. Okay, so again, looking at the balance sheet in terms of perspective, issuer perspective, investor perspective, pagdating sa accounting standards for classification and measurement, from the issuer's perspective, dalawa lang po ang categories. Fair value to profit and loss or amortized cost. Now, the difference is that fair value to profit and loss, as the name suggests, that financial liability gets remeasured regularly at its fair value. Amortized cost instruments naman, once you book it at transaction historical cost, you keep that amount plus minus amortization of any premium or discount. Ganun lang. Yun lang ang categories pagdating sa financial liabilities. Ang equity, isang category lang ng equity, kung the issuer of the instrument, the definition, the economic substance of that instrument does not contain any commitment nor any fixed or determinable payment of future cash flows, then that is an equity instrument. Again, sa issuer perspective, under classification and measurement, dalawa lang ang categories ng financial liabilities. Amortized cost and at fair value, with fair value changes reported in profit and loss or income statement. And as the graphic shows, majority of the financial instruments that we see in the market are mostly at amortized cost. Nagkakaroon lang ng FVPL liabilities kapag merong derivative contracts that have negative value, meaning the holder of that contract is obligated to pay out a certain amount, assuming that contract matures at that period of time. So malinaw tayo pagdating sa issuer perspective. What is really the sticking point of classification and measurement under IFRS 9 would be on investor perspective. Tatlo ang categories: fair value to profit and loss, fair value through other comprehensive income, and amortized cost. Again, dalawa ang measurement basis, at amortized cost or at fair value. Under amortized cost, wala tayong problema dyan. At cost yan, plus or minus amortization of premium or discount, which we'll discuss later. The other category is at fair value. But that category is split between fair value, with fair value changes being reported in P&L, the other being fair value with fair value changes being reported not in P&L but in equity under other comprehensive income. I'll explain later why there is a difference. Okay. We talk about amortized cost and fair value. And usually, we start with the principal amount. Ito yung most likely familiar tayo, especially for debt financial instruments. The principal amount is the amount contained in the certificate as the amount that will be paid back at maturity. However, instruments get issued at a premium or at a discount depending on the prevailing economic environment at the time of issuance. An instrument is issued at a premium if the effective interest rate or prevailing coupon rate of the instrument is higher than the market rate. if an instrument bears a coupon interest of 10%, but the market is currently just asking for, let's say, 7% for the same terms and conditions of the instrument, that instrument is said to be at a premium. Conversely, an instrument that has a coupon rate of, let's just say, 8%, but the prevailing interest rate at the time is 12% for the same terms and conditions, that instrument is said to be issued at a discount. And that premium or discount is when you add it to the principal amount, that is your amortized cost. Amortized cost is principal plus unamortized premium or discount. Kasi that premium or discount, natutunaw yon, ina-amortize yun over time. In such a way that by the time the maturity comes in, that premium or discount becomes zero, you're left with just the principal amount. Fair market value, actually, I'm sorry, amortized cost is usually the cash out. So a bond with a par value of 100 but purchased at 105, meaning naglabas ng pera ng 105 yung pumili. The 5 is premium or discount over the principal amount. The fair value is actually either on top of or reducing that amortized cost, depending on the net unrealized gain or loss, which is driven by the prevailing market rate subsequent to the initial recognition date. And instruments that are carried at fair value are usually the ones that generate fair value changes, obviously. So amortized cost instruments do not require recognition of fair value gains or losses. So kanina, 105 yung amortized cost. If this instrument was measured at fair value and the fair value calculation resulted in an unrealized gain or unrealized loss of 10, then its fair value is 95. Bakit may term na unrealized? Fair value changes are actually paper gains and losses. It's just a representation of what could be its value had I if I decided to sell it at that point in time. So itong instrument na to, binili ko ng 105. After a few days, nung mark to market ako, ang sabi ng market, I'll buy that for 95. So yung 10 is actually unrealized loss. Na it will become realized if I actually sell the instrument at 95. The net book value adjusts the value further depending on the company's estimated allowance for probable losses as a result of calculating expected credit loss. And ECL is only applicable for debt instruments. Tandaan nyo yan, debt instruments, tapos not measured at fair value to profit or loss. Later, we'll highlight that further. So yeah, face amount, amortized cost, fair value, net book value. Okay, let's talk about classification and measurement under IFRS 9. And I'm pretty sure you're familiar with accounting IFRS 9. And it's quite daunting to study the topic. Pero allow me to simplify it since you only have 2 hours. No? Actually, you only have 45 minutes remaining. Let's simplify it. You only have to answer 2 questions pagdating sa classification and measurement. The first question is, are the cash flows contained in the instrument, in the contract, are they solely payments of principal and interest or SPPI? Are the cash flows contained in the contract, do they represent solely payment of principal and interest? The next question is, what is the company's purpose of holding or having the instrument? What's the business model? No, BMA, business model assessment. Why is the company holding that instrument? So SPPI, the first question, focuses on a cash flow profile of the business, of the instrument. The second question, after answering the first question, the first question is specific to the contract, while the second question looks at why the company has that financial instrument. Is it for accumulation of yield accumulation? Is it for risk management or funding purposes? Is it for short-term profit-taking purposes or for trading purposes? The first question focuses on the contract, the instrument itself. The second question focuses on the company's purpose, on why they have that financial instruments. Ganun lang po kasimple. Dalawa lang ang tanong. Ano ba yung instrument na yan? Ano yung cash flows niyan? SPPI ba yan? Is it solely payment of principal or interest? And anong balak ng company dyan? Para ba yan kolektahin yung interest? Para ba yan pang short-term placement of funds which can be used in the future? Or is it for trading or short-term profit-taking purposes? Now, the first question, SPPI, focuses on the cash flow profile of the instrument. Diba? Tatlo tayong instruments, debt instruments, equity instruments, derivatives. The first instrument, debt instruments rather. Remember yung definition kanina on fixed or determinable amount. A debt instrument contains provisions wherein that particular contract gives the holder the right to collect a fixed or determinable amount in the form usually of principal and interest. So that's why ganyan yung itsura ng ganyan yung itsura ng cash flow mo. Meron kang regular payments of coupon plus a one-time bullet or balloon payment of interest. An equity instrument naman doesn't have any of those contractual commitments or claims on future cash flows. Kasi nga, instead it provides the holder rights or claims in the net assets as well as ability to make corporate decisions. And the cash flows coming from equity instruments could either be generated by selling those rights or by collecting and receiving dividends, which will be generated out of a company's net income. In derivatives, di ba, derivatives could be linear or non-linear. Ito, forwards or swaps. Ito, options. And as the contract's definition suggests, the payoff is driven depending on the market underlying. Saan mapupunta yung interest rates, saan mapupunta ang exchange rates, equity prices, or commodity prices. Wala tayong pinag-usapan about principal or interest. Ang SPPI, ang focus niya, solely payments of principal and interest. So, this question, the first question under IFRS 9 can be answered by a yes or no only. Yun lang ang kailangan nyo tandaan. Yung debt instruments, dahil ang profile niya, fixed and determinable payments of cash flows in the form of principal and interest, most likely papasa siya sa SPPI test. Equity and derivatives, they will fail the SPPI test. Why is the answer to the first question important? Because it simplifies the reporting entity's work. If an instrument passes the SPPI test, meaning it is actually the payments are solely payments of principal and interest, then it could qualify to all other types of the next question, yung business model assessment, the different categories naman yon. But if an instrument fails the SPPI test, automatically FVPL silang lahat. Wala ka na ibang gagawin, automatic yan. That equity instruments and derivatives are by default FVPL instruments with certain exceptions. No? Later, we'll highlight those exceptions. But as a rule, both derivatives and equity instruments would become FVPL. Wala ka na ibang, after, basta bumagsak sila sa SPPI test, FVPL kagad sila. That's the gist of the first question. And dito, again, importante yung substance over form. Even if the instrument is legally an equity instrument, let's say a preferred share, pero the preference shares, the terms are akin to a debt instrument, then it has to be accounted for like a debt instrument, looking at its the solely payments of principal and interest component. And then it has to be accounted for that way. That's the first half of classification and measurement. The second half, the business model assessment, focuses on 3 business models, so to speak. The first is yung business model pertains to the intention of the company on why they have the financial instruments to begin with. The first is they intend to hold that financial instrument until they collect all those cash flows. Hold to collect na eh. Hold until all cash flows have been collected. Another purpose or business model is hold to collect or sell. Yes, we also want to hold to collect the cash flows, but we have the option to sell them anytime if needed. Hold, but can sell if needed. The third purpose or business model is held for trading. I may collect cash flows, but I actually intend to sell it when the opportunity arises. Meaning if there's a profit that I can generate by selling it outright now, I don't have to wait for its cash flows to be collected because I intend to trade it anyway. So yan yung tatlong business models. The first question, SPPI, focuses on the instrument itself. The second question focuses on the company holding and owning the instrument. What do they intend to do with it? Do they intend to hold until all cash flows have been collected? Hold to collect. Do they intend to hold, but also will sell if needed? Hold to collect or sell? Or do they sell it when the opportunity arises? Held for trading. Yan yung tatlong categories. Tatlong business models that drive the categories. Etong si hold to collect, amortized cost ang kanyang category. Etong si hold to collect or sell, FVOCI yan. Si held for trading naman, FVPL yan. Yan ang niya. And each of the categories are aligned to their purposes. Pag hold to collect, what is relevant to you is the amortized cost. Kasi gusto mo makita from end to end, from the point of acquisition up until mag-mature siya. Amortized cost ang relevant doon. Si held for trading naman, Since at the beginning, gusto mo talagang magkapera when the opportunity arises, that means it's part of your operation, it's part of your business. Kaya gusto mo i-reflect sa P&L yung fair value changes. Si hold to collect or sell nasa gitna. Alanganin. Kailangan mo siyang at fair value kasi may intention kang to sell. Pero hindi mo naman necessarily gusto siyang ibenta unless kinakailangan. So, doon siya sa gitna. Other comprehensive income. Yun yung how do we align the three business models from the three categories, which we'll illustrate right now. Debt instrument, equity instrument, derivatives. So, kabilang side, ang categories mo, FVPL, FVOCI, amortized cost. Now, the name fair value to profit and loss, fair value. It will always be remeasured at fair value. Remember, financial instruments, their value is volatile and it's much more relevant to know its current prices or fair value to make an informed decision on what to do with the instrument. And FVPL instruments, pag held for trading, kasi you already decided that part of your measurement is on your performance is in your ability to generate opportunistic profits. So that's part of P&L. Amortized cost, dahil nga gusto mo siyang makolekta until maturity, si FVOCI nasa gitna. Kailangan mo siya at fair value kasi ibebenta mo yung instrument, pero hindi mo naman in-intend na ma-measure yun, a part of your measurement of your operations. Kasi nga, you'll only sell it if needed. Kaya sa gitna siya, other comprehensive income. The first question again, SPPI, either fail or pass. All instruments that fail the SPPI test, some debt instruments will also fail, especially if the debt instrument has provisions that do not necessarily mean that the cash flows only contain solely payments of principal or interest. As mentioned, equity instruments, they would automatically fail. Derivatives also automatically fail the SPPI test. And all those instruments that fail the SPPI test because they don't contain cash flows that are solely payment of principal and interest, all of them are categorized as FVPL. Now, I mentioned merong exception. On a one-time basis, equity instruments can be categorized as MVOCI. No? But only one time at the point of recognition. After that, you cannot change the categorization. The reason is that the standards recognize that certain equity instruments were acquired for strategic or non-trading purposes. For example, accumulation of shares so that eventually the company can be acquired and merged or become a subsidiary. They are not necessarily for trading, but they will fail the SPPI test. So the concession there, sige, you have an exception, you can use the MVOCI category. Instruments that pass the SPPI test are usually debt instruments. Again, si equity, si derivatives, they would always fail. Debt instruments that pass the SPPI test, sila yung dadaan dun sa next question, business model assessment. Para saan ba yan? Bakit ba natin yan binili? Is it for trading purposes? FVPL yan. Is it hold to collect or sell? FVOCI yan. Is it debt instrument to hold to collect only? Amortized cost yan. So, the first question, SPPI test, simplifies the exercise kasi all those that have failed the SPPI test, all those that are not, cash flows that are not solely payments of principal and interest, they are all FVPL. Those that are passed go through the next question, which is company specific. What's the purpose of holding that instrument? Is it for trading? Is it for hold to collect or sell? Or is it hold to collect only? Because it will likewise drive and determine the category of that instrument. Pag For trading, FVPL. Hold to collect or sell, FVOCI. Hold to collect only, amortized cost. Fair value to profit and loss instruments, their fair value changes are reported in P&L. Why? Because the standards recognize that either that instrument, because it failed the SPPI test, it's highly likely volatile in nature. Kasi hindi yan principal and interest. Therefore, I'm forcing you to query that fair value with fair value changes reported in P&L so that for transparency purposes, all the risks attributed to that instrument gets reported as part of the company's operation. Fair value changes naman ng FVOCI, sa OCI in equity siya. Kasi nga, alanganin, hindi naman talaga siya risky kasi papasa siya ng SPPI test. Pero hindi naman siya hold to collect only kasi I can sell it if I need to. Hence, the fair value number is relevant. Amortized cost, wala kang fair value computation kasi at amortized cost. Pag you're going to keep the instruments until its maturity, the fair value is irrelevant to you. That's classification and measurement.